over 1,500 electric vehicle chargers, has delivered more than 2.5 million charging across its 2.5 million minutes in charging across its deployed infrastructure. Sorry, that was hard for me to say. So there's a lot for us to dive into here. But to start at a high level, how do you kind of think about the state of DePIN on Solana today?
Yeah, I'll take that one to start with. I think that's a great one. Solana, obviously, the really scalable network for so that people don't even need to worry about the infra, and it's really high performant. It has grown tremendously over the years, and it was a no-brainer since the start for us. Deepin on Solana has actually been very, very interesting because it has moved on from experimentation towards actual execution. Right? When we say execution, it's about almost like making sure the real throughput is managed with users as well as real assets. Right? It's no longer about just emission-based high capex models. It's even to kind of do justice to the specialization, right? Previously, we have seen a lot of specialization, like wireless. You have helium mapping, you have high mapper, and now you have seen the next frontier of category that's happening, right? Which is energy layer, right? We've seen startups like Daylight, um, as well as Fuse Energy, right? These are kind of showcasing the next frontier that's actually about to happen and going to have an insatiable amount of demand, right? So when you see three of a kind, you know that this sector is about to be big, and we are glad to be kind of progressing on that frontier. So really excited to be building on the best of both worlds. That's pretty much summarizes the state of DeepL on Solana.
Mhm. And then what about the EV side of things? What do you think others are still getting wrong on this front and that DePIN on Solana can enable?
Yeah, let me take that, and then Prakash can also join to round it off. So I don't think anyone's getting anything wrong right now. I think it's probably the approach that works best. Just like every other industry that is nascent, I think it will take a few iterations for the entire ecosystem as a whole to work together and grow and iterate to see what best fits and what doesn't. Obviously, there will be some failing models because the economy doesn't support it or the community doesn't work with it. But I think at DCharge we found the sweet spot where we went through the grind the hard way, and then we deployed our own charging stations. We found out what others were doing wrong, not necessarily because they knew that they were doing it wrong, but what was really the big burner was that there's insane amounts of money and capital that is deployed on each charging station, and then there's also a lot of money that goes into pre-processing that we call, just to identify the location, to get the leases, to get the electrical drawings, and it's a lot of expense and time, right? And it takes the life out of people. Like, to get a charging infra up and running is no mean feat. So we have massive respect for all the other charge point operators who've done it the hard way, like we did. And I think the model is now evolving towards a point where we are seeing this bunch of charge point operators who are just going all in and deploying a lot of capital, and then they're okay to wait for a good 3 to 4 years to get their returns. I think that is where they're getting wrong. But what we did well by learning from those mistakes is using the Web3 layer to bring a layer of capital that can subsidize the charging installations itself, and then utilizing and reinventing the entire supply chain from the core to where we are today, so that we accelerate the entire process of deployment and cut it short from like 24-25 weeks to about four to 5 weeks, and then reinventing the entire supply chain of everything from acquisitions, purchases, costs, installations, etc. So I think that is where we are right now, and of course Solana has really helped us get to where we are because of the community, because of the speed of transactions, and we are seeing a lot of liquidity pools and liquidity providers who are interested in deploying capital through our pools to support this initiative.
Hmm. Yeah, DeCharge also updated its business model recently. I know I saw that on X. Can you kind of tell us more about the decision behind that and why you guys decided to go down that route?
Yeah, so I think I'll extend from my previous conversation about what I said earlier, and then the point being, I wouldn't call that as an update to the business model. I would think I would term it as a natural evolution of sorts, because let's say that let's say you play a game and at a certain point you unlock new superpowers, right? So that is what we ended up doing over the last 2 years. We played the game as it is, we were very focused. And then through this entire process, we just realized that, hey, there are so many gaps in this that can really elevate the entire industry to like to accelerate the industry by 5x or 10x. Because if you take a zoom out and then observe the state of the industry, we have two major players, right? We have the EV owners and the consumers, the demand layer, and then we have the supply layer. For the first year, 2 years, we've been playing in the supply layer by aggregating demand. So we were setting up our charging infrastructure, still are at key locations, and we use Deepin as a foundation to accelerate that process and not get into the pitfalls of it. And as we deployed about 1100 chargers around the world and started understanding the ecosystem, we started growing the demand on our network, and we would go out to fleets and retail users to start using our charging network. And through this process over the last many months, we noticed that, hey, demand can come from anywhere, right? Like it can come from San Francisco, it can come from Mumbai, it can come from Delhi, but it doesn't necessarily mean that we have a charger in every location that the demand comes from. Like it could even come from maybe Ohio, or it can come from like Toronto, Canada, right? But so what we started doing is then we started approaching other charging companies who have a network there and said, look, I have a lot of demand and I want to use your network and it will help your utilization. And everybody were super happy for that because they were also sitting on idle time. They were all dealing with the same problem that we were dealing with, because they would have chargers, but the demand can come from anywhere at any time, and the charger may or may not be in that location. So together we kind of maximize the utilization, and we, like, the entire ecosystem of partners became profitable. Then that made us realize that, hey, we are now so good at aggregating demand. Like we have retail fleets, which tens of thousands of cars. We have retail users who are all trusting DeCharge, and at key locations we have a chargers, but it's physically impossible to go set up a charger in every city in the world in such a short span. But there's always a charge point company in every city in the world that has a minimal network which is limited to that. So we then started aggregating these partners onto the DeCharge network, and through Web3 principles, we started saying you will also earn token emissions for participating in the network, but you'll also have a bigger utilization. And this was the Eureka movement for the industry. And the charge point operators also started taking us very seriously because we had skin in the game. If we were a random company that would just go walk to them and say, hey, do you want to give your charges on my network? They'll say, why would I even do that, right? I mean, because we went through the grind together and we were working for months together, they know that we understand the problem statement really well. So and those charge point operators cannot really do what we are doing because they would have already invested like hundreds of millions of dollars, and their focus is infrastructure. They're not really good at the aggregation or demand generation. They focus on infra, and we are really good at demand. So that's how we evolved into a place where we started talking to all of these charge point operators now, and everybody is giving us a fleet discount rates, which is about 40% cheaper than the retail rate, and we are making an upfront 40% on that. And now when we go to the demand, we are giving it to them at a 15% discounted rate, so that if they go through the DeCharge network, they earn incentives, which is whatever incentives they are, plus they get a discounted rate on our charges anywhere in the world. And fleets are the happiest because now they don't need to talk to every charge point operator to make an agreement in every city. They can just talk to DeCharge and we can enable them anywhere, right? So that is how we ended up where we are, because now it's become a perfect culmination of arbitrage. So we know the demand exists. We are not creating demand. We are doing what AWS did to the entire ecosystem of compute. Compute demand always existed, but it was fragmented. AWS came and aggregated everything together. It made it what it is today. So we are doing the same thing for energy demand. That's the journey, basically.
I love that. So it's like essentially creating the demand through incentives, different structures, and then also that AWS component, like you mentioned.
Yeah, it's more of a coordination layer, if you ask me. So there is no coordination layer. There's nobody else doing what we are doing right now anywhere in the world. Anywhere in the world. So it's taking us less than like a week of to and fro conversations to onboard a charging infra provider or a fleet right now. There's literally no one doing it. If we take the AWS analogy, we're probably the first to do that in the energy space.
Mm-hmm. Amazing. I mean, there's also the category of DePIN finance or DePINFi pools that DeCharge is using as a capital formation layer on this node. I know we're going to pull up a graphic here. How does this kind of change the game for individual EV charging projects with what we were just discussing?
I'll probably add 2 lines and then over to Prakash if he wants to add
Hmm.
something. But at the individual EV project level, it is not disruptive. It is very constructive in that sense. Sorry, 1 second, guys. So sorry.
No, you're good.
So at an individual EV charger level, there's no disruption at all. I don't think it changes the game for them, except for the fact that sorry, I saw the message. I got distracted. Can I go over from the start?
Yeah, sure. I mean, so on the front of the category of deep in finance and deep in fi pools that DeCharge is using as a capital formation layer, how does that kind of change the game for EV charging projects?
So I don't think it changes anything for the EV projects except for the fact that it gives them more opportunity. I think it's for the better. It accelerates their ability to use the community and their demand to deploy at locations where there is a high need. I think that is what changes for them. Instead of being dormant and setting up a charger and hoping that demand would turn up, it's we flipped the game and said that okay, this is where the demand is, and it's your network. If you want to deploy there, that's great, and we'll give you access to the entire pipeline, right? Like if you want to acquire a charger at a very cheap rate, we've got a partner. If you want to do an installer, we have an installer. We can just help them connect all the dots right to go live, right? Including finance. Like we have these DeFi pools that are there to deploy. So if we are convinced that the location is great and the demand shows that the location is great and we know it's going to be utilized, we have partners who will come and pick it up and do it. And them being local to that location also means that the execution speed is really, really fast. So this is has really accelerated that entire pace. But on the other hand, what it also does to the community and the liquidity providers is where I think the win lies, because whenever we did uh, liquidity pools in the past 4 or 5 ones that we did, it was filled up very quickly. But one of the biggest questions that people or liquidity providers or community had was how long would the capital be locked into it. So we would say, okay, it would be locked for about a year or so, or a few years, depending on how big the project is, because it becomes profitable in year 3, and then from there it starts making money. But here's your yield regardless, right? But now the model that we're working on has really unlocked so much financial economic upside that on the demand already exists, right? That's the key here. So wherever we go, we raise a pool of $100,000, we are able to actually pre-buy energy for $100,000 across multiple networks because we know where the demand is, and then the entire energy, the $100,000 worth of energy, is consumed in a couple of weeks by recurring demand, the same set of cars. So this is not an industry where somebody comes and they say, okay, I'll come back next year, right? They come back at least 2 times or 3 times a week to recharge. So we have a very captive user base. And now this $100,000, let's say it gets us a few hundred megawatts of energy, just for example. All of those will get consumed in a few weeks. And then immediately after that, and that gives us a yield of between 18 to 30%, depending on which, where, and how we deploy. And then after third or fourth week, we redeploy the $100,000. So it keeps making this yield on every cycle. So it's not a one-time thing. So now it becomes that, hey, if you're an LP provider or a user, everything changes for you because this has become so much more liquid than it was earlier. So again, we have brought in the principle of insane liquidity into a deepened infrastructure company, which predominantly has roots, has a behavior, or has a, what do you call it, has a attribute of being delayed in payments, like, because it's infra, it's supposed to be slow and long term, but now we made it short term and quick. So I think that is what changes for the entire ecosystem on both sides.
Mhm. Prakash, as the head of growth, how do you kind of see these pools changing over time? And then, in practice, going off what Mohan's talking about here, like each DeepInFi pool is like a slice of tokenized energy. So what does that
Yeah.
ultimately mean for contributors?
Yeah, I think at the end of the day, you're solving a problem statement, right? What's really exciting is that right now each pool represents like a claim on future energy throughput, right? It's not just speculation. So it's like backed by actual cash flows, and the contributors are essentially like kind of underwriting actual real business, right? And these returns come from charging revenues and performance links and incentives. So this way, kind of risk is kind of localized, and this really matters a lot for emerging markets. We are talking to a lot of LP funds who are actually expressing interest in this because cheap capital is well utilized in emerging markets. That's something we are really demonstrated, and we are able to aggregate demand really well. Of course, this model kind of changes differently in capital markets. But what we are able to kind of enable through the deepify aspect is to bridge the gap really directly. This benefits local hosts and global capital providers much easier because it's if you look at the broader spectrum of market, it's either the smaller chargepoint operator that's self-sufficient, but they still want to grow the network, and there are the top 10 companies who are the only ones performing, right? And the in between chargepoint operators who neither have good revenue or good growth, right? So that's where we bring a lot of value add, and we make sure that we function as the demand aggregator, and we give them a higher utilization. I think that has been a bigger value add, which traditional banks cannot underwrite, and they cannot underwrite it very quickly, right? Takes them probably like 6 to 12 months, which is not good for the business. And I think this where kind of the internet capital market really comes into the play.
Mhm. That makes sense. I mean, in the broader ecosystem, how do you kind of think about how this plays into Solana's emerging capital market sector? And then how else do you see like DePINs like DeCharges evolving that push towards that open capital markets that Solana's been, aiming for in the long term?
Yeah, I think almost everyone knows that Solana's institutional capital market really has advanced really well, right? You see Ondo launching recently on Solana, bigger capital markets. The way that we see ourselves, these are like micro infrastructure bonds, right? Micro infrastructure bonds settling on Solana with proper issuance and settlement. All the accounting happens on chain, right? And this low friction makes each small ticket infra value really viable. And before you kind of spread across like really institutional grade capital markets, where because a lot of LP funds there, if you go to the minimum check sizes ranges from 5 to 10, right? The way to get to that is making sure that you show these kind of markets evolve and how these cash flows are actually happening. That is how the capital formation really happens. This is a much more interesting and fascinating. I would say it's almost, I think, one will expand a bit more. It's like very bear market friendly. It's not like the risky DeFi recycling that happens. Tons of looping happens. So none of that here. It's straight up simpler to understand for people. We are able to kind of bring down the lock-in period to very less, almost like to closer to 2 weeks because of this iteration. So I think that's how we kind of see this effect compounding to the broader RWA basis.
Mhm.
We are almost like sitting at the intersection of RWA and cash flow and real usage. And real users is what kind of contribute to the network, and that's the biggest win that we have seen so far.
Mhm. Yeah. I see Mohan, you're nodding. Anything you want to add on that? Or you're just like 100% you agree with that?
No, I'm 100% like you.
Yeah.
It just becomes a duplicate if I say that. Anything else,
Yeah.
but yeah. I love what you said because I was about to say it's great. We are probably one of those projects which is very bear market friendly. The market is not doing great, uh, but people will never stop traveling. They will never stop charging their cars. Right? I mean, energy is something that's always a constant. So yeah, I mean, if I were to have a portfolio, I would really hedge it against something like DeCharge because it's
Mhm.
there.
Yeah.
Just
There we go. When you think about the broader RWA thesis, how does DeepInFi and GCharge fit into that?
I think this we kind of addressed, but Eleni will take another stab at it. So, kind of recharge sits at the intersection of RWA, cash flow that is backed, and real usage, right? I think a lot of it is much easier when you're able to actually track it. Like today, most anyone who deploys capital, they can actually see the actual energy consumption happening on chain. So it's much easier for them to trust the system. And in the real world, we have trusted user base, trusted consumer base. We have really good sales pipeline. Previously, there were charge point operators who were always competing against us, and now they work with us. That's a bigger unlock that we have had, right? And we see this model kind of evolve. The same model kind of extends towards Southeast Asian markets. So this is not a one geography specific problem. It's something really expandable, and I think that's how capital unlocks really happen well. So tokenized treasuries, real estate, you will see a lot of these guys also show interest. You will also see DATs, right? I think DATs also want to deploy, diversify their portfolio in towards receive capital versus stable yield as well, right? Some of them we have even approaches for you. They're even okay with 9 to 10%. That is something we can very much deliver, and everything else on top of it is like performance based. So this is because nobody's ever going to stop using energy, and that I think that is the biggest excitement. And revenue is something that continues. And our user retention costs are really good because as long as you access a reliable charge point that is going to be a prime spot, and people always keep coming back. And that's what it really makes it ideal for on-chain settlement and towards the broader RWA stack.
Mm. I mentioned in the intro that DeCharge surpassed 2.5 million minutes of EV charging across the network. What does this milestone really mean for DeCharge? And then following this conversation about users, how does that kind of reflect traction in the network, and where do you see that going?
Well, that has been an incredible. We've seen incredible growth on the network itself over the past few months, and we are seeing it grow steadily month on month. Especially with our new approach of onboarding different charge point operators, it is going like crazy. It's going up like crazy to a point where we are, you know, uh, maybe we now move the metric to megawatts consumed. It will be like a lot. So I think this is a very good sign for the entire industry, and it shows a lot of maturity that we have reached a level of maturity in the model itself that is scalable, sustainable, and also programmable. The reason why I say that is we are bringing all of this demand on chain, and we are letting people, and especially contributors to the network, whether it is financiers, whether it is the EV owners, or whether it is the fleets, or whether it is charge point operators, create a mechanism of smart contracts where they can actually program how the money flows and then how quickly they can burn it out. And depending on that, they can program whether they want to take lesser yield or higher yield, whatever, on the user, on the contributor side, and on the CPO side. They can also program whether they want to take charge lower or higher depending on how quickly they want to churn the energy on the network on utilization, right? So this, so far, it shows a lot of confidence in network. We have seen a very constant uptime of over 97% of the network, very few complaints on the network, and it's translating into real revenues for everyone. And this actually directly ties into the narrative that demand exists. Like we are just like it shows over and over again that we are not there to create new demand. We are not here to change any user behavior by getting them to buy into a new product or a new service that we are giving. It's just that the demand exists, it's fragmented, it's everywhere, it's the winner in the bear market, and people will want to come and start using chargers when they know that there is availability and there is traceability and then there is discovery that's easy to them. Otherwise, they just end up going to random charging stations, going to random places. It is not repeatable behavior, but we are bringing that layer of coordination across the full spectrum, and I think we're going to see us hitting 10 million minutes over the next few months very easily. Like that's because we've aggregated so much demand across multiple networks, and it's a logical no-brainer for us. Yeah, I think it's insane traction that we're seeing. We just have to keep hitting the gas pedal and keep going, of the electric pedal and keep going as quickly as we can.
There you go. 10 million, so that's a 4x in a few months. What about by the end of the year?
Wow, that's great. I think instead of like we've already crossed around 500 megawatts of energy dispensed, and to be honest, we are losing track of how many minutes that is on a daily basis because it's happening so much across so many networks.
Yeah.
At the end of the year, I think we will have easily crossed at least 40-45 million minutes on the network. At least is what I'm thinking. I hope we do much more than that, but a minimum would be 40 million. So 4x in the next few months, and then 4x that across the year. Even if we keep that sustained for the next 3 quarters, we'll still hit 40 million minutes.
There we go. All right, that's awesome. I know DeCharge has also been working with ReFi Hub to launch its DeFi pool that funds 19 EV chargers in or near Bangalore, and it raised about $150,000 in 12 days ahead of moving into actual operation, which is pretty impressive because it was funded before it happened. And how do you think about these projects, demonstrating the scalability and the global potential of the this decentralized EV infrastructure. Like we're seeing it play out in real time, but then what is kind of now the next step?
Yeah, that's the exciting one because we actually had the recent payout for the community participants, and they were really happy because they could actually not believe it because even though we had almost like killed timelines as much as possible to get the best possible yield for the users, and they had like a 24% yield payout after net revenues. This is a significant watershed moment because goes back to what we were speaking earlier, right? We had to move toward beyond just experimentation as opposed to the data will be value accrual is a very long time, but it's very important to give that what is that yield component that's actually sustainable for people, right? That's how we came to have the refi hub because it was important. It showed what model is repeatable and not just experimental, right? These are real money with real users. Because funding these charges and raising this capital demonstrated that there is real demand for infrastructure-backed participation even at a small ticket size. It's very important because we could have gone for a bigger amount, and but we wanted to make sure we under we did not under deliver, right? We kind of over promised, and sorry, we actually kind of over delivered in our metrics. So this is what was possible because of fast capital formation, transparent deployments, and will also be moving forward towards IoT based monitoring. I think this is how kind of models really scales. The more and more people see in terms of transparency, the model scales up really well. I think this goes to a lot of projects as well. I think a lot of projects demanded more transparency from projects in terms of whether it's buybacks or utilization. I think that has added to sustainability of a lot of other projects in terms of token value accrual. And the same thing happens here, right? This model, we want to make sure it's repeatable, and the capital formation is everything, right? And making sure the value goes back to the consumers, and that's what we kind of wanted to prove. And this has really been our biggest PMF signal for so far, and being able to kind of repeat it over and over. So obviously, I think this will not be always happening. We carefully pick up locations that are really profitable. We do our own data analysis and make sure that traffic score really matches the demand that is possible, and it beats industry standards. And this is definitely scalable in a lot of emerging markets. The structure stays the same, while infrastructure kind of adapt to the local demands, and that's how we kind of see it expand month on month for repair modeling.
Mhm. And then on the expansion front globally, I know we talked about this a little bit before, and I know DeCharge is available in over 20 countries. And throughout Q4, it continued its US rollout, which I'm excited about because I live here, and expanding pilot deployments and community hosting models. What is kind of the biggest takeaway from this initiative, and where are you seeing the most engagement?
We are seeing a lot of interest from small and medium businesses, mom and pop stores, because that is what uh, has become a validation of business for us, and it's happening across Southeast Asia, across US, even parts of Europe. Over the last 8 months, we've been extremely aggressive in our growth. We wanted to just go all out and just spend every minute that we have to just make sure that we get this model right, because time is of essence here. Because if we take a step back and see the state of this market, the number of electric cars that are being sold is growing exponentially, while the number of chargers available is flatlined. Like in a way, it's not flatlined; it's linear rather. So there's always this growing gap, and that's growing on a daily basis, right? So it's rather than a market failure, I would like to see it as an opportunity that is money lost on a daily basis. So what we went into each market is when we tried different segments. We wanted to understand where it works best, and we have seen that small medium businesses, mom and pop stores, are the best adopters for this, and they are very very excited to do this. Also on the other side, we have seen a lot of interest coming from private fleets, logistics fleets, and retail, which is closer to in each suburb. It's very concentrated. So these are the patterns that we have seen repeating over and over and over again, and a definitive success. And the same model and the same template actually is similar across geographies. So it's not limited to the US market or not limited to the Thailand market. We are seeing the same pattern, the same template that is working everywhere else. Because I think I'll draw one example from what Prakash was saying earlier. He talked about micropayments, right? He talked about something saying it's a micropayment. But I think that the fact of the matter lies in the fact that that is true. The money is in the micropayments. Okay, it's a complicated statement. I'll simplify it. the holy grail is in the fact that the micro payments is where the money is. So when you look at, again, example of AWS, they charge a few cents every hour. Like maybe you pay 20 cents per hour, which is actually a micro payment, but then it amounts to billions of dollars. The same thing is here. We charge a few cents, like 25, 30 cents per kilowatt per unit of electricity, but it's repeatable on a daily basis, and it's across millions of vehicles and millions of chargers around the world. So, and that demand exists today. And this is what a lot of medium small businesses are understanding by doing pilot deployments, because A, they have access to parking, and B, they have access to electricity, and they just have to just do a one click install with DeCharge or through our partner of ours, and they start making money instantly, right? And we are filling the demand layer because we are saying we have a partnership with the fleet. And if a fleet has let's say 2000 cars, it is physically very difficult for most of the fleets to charge all 2000 cars in the same location, because that requires access to an insane amount of energy through grid. It will actually impact the grid, so they need to distribute it, and they are looking at ways to distribute it. Right now they're doing it through very expensive ways by having different hubs. They have to manage the hubs, they have to have multiple agreements, blah blah blah. Now they have the option to go to a mom and pop store, or our partner, and say, look, I'll leave 3 of my cars overnight in this parking, and the next morning they'll come and collect it. Because, and the fleets all don't have to come back and bring their cars every night into one location, right? It is such a big win, and that's why we're being so sought after. This is what we are seeing everywhere. It is a big problem, and we're solving it really fast. And yeah, I think that's the winning factor for us.
Mhm. So then kind of thinking forward looking, obviously with all of this mine, DeCharge has emphasized, community participation. We've talked about the reward structures, incentives, how small to medium businesses are looking at this. When you think about adoption and engagement so far, and then the road ahead, what really is the big unlock here?
So in terms of community participation, what we are able to achieve is like turning users into contributors is like something is a massive unlock. They're not just consumers; they're actually kind of contributors to the network, right? Because there is a nice repeatable behavior when you have like interesting quests. Because not even if they're not crypto native, they are. We have like traditional models like digital gold and all of it. And I think, of course, gold as a commodity has been rising, and even that prompts them into adopting, and word of mouth happens. And we also have the delayed gratification of point system which they can redeem for tokens in future. That is also like really driving the Gen Z audience. That is something we are seeing in terms of user behavior. So just in the last month, we have seen like close to 50,000 users use the network actively, and at least 5,000 of them are recurring users, right? And we don't even have to put an extra dollar to retain the customer. So that's something that's great. So all these programs like quests, reporting, and rewards, the kind of support operations in a way kind of minimizing cost. We also have like exciting quests like site discovery, uptime monitoring. Even if these are charges that are not on a network, because that gives us inherent data, insane amount of data, and we can actually approach the clients with extreme confidence. So this is a way to kind of like a business hack. It reduces operational overhead, and our deployment partner equality becomes really massive. And this pattern is what we intend to scale globally as well, right? I think one alpha that I can say is we are making an app that is going to be live on the Seeker, hopefully in like a month or so, which will just reward users just for like discovering the nearest charge point operator, charging, whether it's working or not, or that it's actually functioning, or no longer functioning. Because this data actually gives us a big heads up. We don't even need to deploy. We can reach out to the nearest charge point operator, say that there is actual demand. You know what? We can be your partner network and drive demand towards it. That is some bigger unlock we are actually excited to look at. So over time, this really creates is requires small local community who become really good contributors to the network, and this network effects is only kind of scale, right? So I think that's something I really personally see as a long term horizon, and these are the data points we expect to kind of really scale up. That's going to be bigger unlock. I think we have already seen this. I think GeoNet did also a great secret app engagement. I think that's something we have followed and studied. This is going to be like a really good fun quest for people to actually engage in real world apps through the real world apps as possible.
Mhm. What about on the partnership front? Your team has partnered with a number of infrastructure providers. We could pull that up here. How is that kind of moving the needle for DeCharge, and what is this really providing? I guess we can't go through every single one, but maybe a holistic overview on this front.
Yeah, no, I love this. Is probably my favorite question, and again, shout out to all our partners. And if you rewind this conversation a little bit, in the beginning, I categorized this entire ecosystem into two pillars, right? The demand and the supply. Recharge has been able to really bring those two together in a way that's never been done before, and the nature of each pillar is to function to its optimal level, right? Let's say, for example, we take the supply side of things. Supply side is going to be other charge point operators or other manufacturers or OEMs who manufacture and sell chargers. They are all laser focused. They need to be laser focused on reducing supply chain costs or reducing the cost of the charger. For CPOs, they need to be laser focused on finding new locations. They need to be focused on installing new hardware, etc. So in this layer, what is missing is their ability to allocate a big chunk of funds or time for user acquisition, for demand acquisition. Because let's say a charge point operator has $500,000 surplus, that their thinking is always going to be towards setting up maybe two more chargers, because it will be a long-term payout for their investors and the people who invested in their company, because their thesis is to have more infrastructure. It will be very tough for them to go and invest that money into user acquisition, because that's not their nature, right? Similarly, when you look at the demand side of things, we have fleets, right? Like, which are I'm taking the example because they're the big chunk of B2B business. All of these people have dedicated sales managers in each territory, in each city, to find partnerships with chargers so they can maintain a streamlined rate. And it varies from location to location, from city to city, from country to country, from tariff to tariff. There are so many things here. But because we've been on both sides of the story, what we were able to do, and thankfully to our partners as well, we were able to convince everyone, saying that, hey, we will be the bridge between the both of you, and we will create that layer of coordination that elevates us all together. So we are creating this unified energy interface by working with the OEMs, by working with the charge point operators like us, and then also working with the supply demand side of the fleets and retail users, that is collectively bringing the entire ecosystem to a different level altogether. Now, the companies on the supply side, they don't need to start worrying about utilization or customer acquisition or new sales teams in each country or each region, right? They can focus on building infra. They can say, okay, Recharge is taking care of this. On the supply side, or the demand side, they don't need to worry about hiring sales managers and increasing their costs just to find partnerships, because we are giving them a flat rate across. They're all saving money, which is also money earned in one sense, but also they're all increasing the utilization of their network by being in a single coordinated layer of this deployment, right? And together, I think we are seeing an insane elevation of the ecosystem. And because of this trade, we are also seeing a lot of new onboardings. Just in the last 2 weeks, we were able to onboard two big fleets onto the platform and three charge point operators globally, just because of what we are doing. Earlier, it used to take us maybe 4 to 6 weeks to bring somebody on board. Now it's happening in 2 to 3 weeks. And they're just, the more they see the results, the more they're just saying, okay, let them do what they do best. We're doing what PayPal did to the payments ecosystem. You know what I mean? Like, we're not going and competing against Visa and MasterCard, but we're bringing everyone together and saying, hey, let's just increase the net for everyone. So that's why we're here. I think we are also very laser focused and very clear about our function and what we want to do with our partners. And I think that also brings a lot of clarity to them and on why they want to work with us.
Mm-hmm. In exciting news, there is also the Charge token coming. It's not live yet, but it plans to be emitted based on verified charging sessions and energy delivered. How does it align token issuance with real economic activity on the network with that in mind? And then how can a staking gated design kind of create greater demand for the token beyond the initial incentive phase?
Yeah, I think this is the first time we have spoken about it. Of course, we have Horizon during this year, but the core idea, I think, is this took us a lot of iteration before we arrived at it, right? I think a lot of this incentives are very inflationary, right? We very carefully thought about, like, how do we kind of guarantee towards actual value we deliver. There are two ways, right? Most of our energy throughput is occurs on the rails of actual revenue based operations, right? So the incentives only exist when real energy flows to the network. If not, it doesn't. Like there's almost like no concept of mining, because mining is still fine if they're paying revenues on the network, right? So it's kind of emissions are tied towards verifiable charging sessions and energy delivered. Energy delivered is something you can't fake. So I think that's how the incentives offered to the networks, whether it's users, contributors, transmission operators, all across. It's value add based on energy being delivered through the network. I think that's has been the biggest unlock that in the thought process. Uh, I think, of course, there are many ways to kind of ensure this coordination through staking or even like locking. That is seen in the DeFi ecosystem. But I think this, because it is purely based as a revenue generating network, I think all of this kind of encourages future participation, better yield, and all of it. Right? So what we are really seeing is that people don't want they want transparency, which is something we offer. They also want to see like how the value accrual happens. So value accrual is always happening through making sure the happening through the revenues generated on the network, which kind of splits between token buybacks as well as the protocol revenue which is used to fund the operations. So I think this is how we are able to pair up two beautiful aspects. One is the stablecoin yields, as well as token incentives, which right now currently runs as a point system, which kind of shapes the long-term incentives and coordination. And this is something we're really excited about, because there's a lot of different sectors that we see, like neighbors, you like fuse energy that is much closer to the source of energy. We are somewhere in the between, right? Coordination, which requires a really lovely token dynamic. And I think that's how we're kind of iterating on it. There's going to be a lot more iterations around it. We are going to definitely have a place for governance, because emissions are not going to be just very inflationary. You, we're going to make sure that there's a voice behind all the token holders, and governance also has a role to play. But it's making sure that those tokenomics are really sustainable and really adds to the growth of the network. So that's all like we can say for now. But we definitely want to make sure there are some near-term infrastructure performance partners, as well as long-term partnership that we do with companies, and they're very much aligned, as opposed to earlier. Before they were very skeptic, but right now they do see the value, because we get the audits on a monthly basis, and we're able to kind of very get plan for really long-term incentives with all the partners across the world.
Okay. Well, I guess there's a lot to look forward to then, and
Yeah.
anticipate in the coming months or so. Looking ahead for the rest of 2026, we still got about 11 months left. What innovations or network expansions can users, developers, investors, etc., expect from DeCharge? And what are you most excited about on the roadmap? Both of you.
Yeah, I'll add some and then Prakash can join. We are a team that's always growing. We're a team that's always trying to solve the difficult problems, because it's this industry that has been the same for ever, right? Forever since it started. And we are one of the few people who are bringing a lot of innovation into this place. So one of the biggest wins that we have is that we are bringing more DeFi pools into the ecosystem. We are bringing, sorry, one second. So sorry, my son just walked in.
No, you're good.
Sorry, can we go over this question again?
No,
Please,
no,
can
you're
you?
good. We're doing it live, so it's totally fine. But what is the near-term roadmap for DeCharge, and then what are you most excited about? Start from the
Yeah,
top. Yeah.
yeah. As I said, so we are the innovation first company. We've been bringing a lot of structure into a lot of broken processes in this ecosystem for ever since the whole electric industry started. Most of the things that are being done today have been the same. There's not been any major innovations, right? Like, let's say for example, for many decades banking was the same, right? You would go to the bank, have a check, withdraw money. But then net banking has kind of changed everything, and now people are just banking over the internet, and it's led to the financial disruption that we see today of being able to move money with so much ease across borders. We are doing something very similar for energy, because we're a global player. Uh, we've seen a lot of our partners and a lot of people we work with in charge point operators. They're very limited to geography. Even if they have a lot of capital, they're at most limited to the geography of a country. But there are thousands and thousands of players who are limited to the geography of cities or localities or provinces. So we're now bringing a structure, and we're bringing technology as the lever that brings everybody onto a platform, and that allows us to be able to route this demand innovatively and in a more structured way, programmatically across the entire ecosystem, so that everybody gets access and utilization increased. At the same time, we're also this is also enabling the participants of the ecosystem, like the users, like retail users and fleets, to also understand that there is access to charging infrastructure closest to them, including DeCharge's own infrastructure, right? So apart from that, I think we will keep innovating on the deep in fi aspect of it, where finance becomes the enabler for growth for the entire ecosystem, while also generating insane amounts of economic upside for the participants on both sides. And in the midterm, I think we are seeing a lot of innovation that will come through in the secondary markets, and in technology, we're looking at advanced routing and optimization, cross geography, capital flows. These are the three in the midterm. On the long term, I think we're looking at Decharge becoming the energy capital market layer for autonomous vehicles, not just electric vehicles. Because when you talk about energy, it's not just limited to electric vehicles. It's a much bigger scope. We have robots, we have eVTOLs, we have all of these classification of machines that will run autonomously and will need access to reliable charging infrastructure. And that knowledge doesn't exist. And now that we're building the entire coordination layer, it makes us the prime participant in this ecosystem to help the machine economy also understand how they consume energy and where they can recharge next, because that's critical to the growth of the energy to compute economy as well. So, yeah, I think that's how we'll grow beyond our current EV borders, but a lot is in store. Over to you, Prakash, if you want to add something.
Yeah.
Yeah. Yeah, just to add on to that, I think the core of it all is I think what's we are really grown to appreciate the data behind everything. I think this is one of the favorite quotes that Jack Dorsey mentioned about Twitter is like how uh, underrated the data on neural network is. We often tend to overlook it. So we always take a step back and see what's working and how do we keep improving. And that has been a strong backbone for us. Because that's one thing connects everything, right from user behavior to actual energy conversion. So I think looking at the data, consolidating it, and making sure it acts transparently, right? That thing that's what gets community excited because people don't are kind of, to be very honest, people are kind of getting really jaded by the very speculative narratives that they cannot hold on to. People want to kind of have more transparency to what's happening. That can have much more better trust for the people, and I think that's where we kind of heading towards. So all of our efforts from the tech core front is going to be towards that, making sure that it kind of scales and benefits a lot of people in the industry.
Yeah, amazing. Well, thank you both for taking the time to share all of those insights and kind of the roadmap ahead for 2026. Lots of exciting times ahead. And thank you to everyone else for listening in.
Thank you, Jack, for having us.
Yes,
Always
thanks.
love to be on the
Thanks,
podcast.
Jack, and kudos to the entire relation.